Welcome. My name is Marcy Hampton, and I'm a faculty member at the UCF Dixon School of Accounting. In this short lecture, I'm going to talk about MACRS depreciation. This is video 3 of a 3-video set. This video will deal with Section 179 and bonus depreciation on tangible personal property. With tangible personal property, we have the ability to expense assets under what we call Section 179 of the Internal Revenue Code. This is an election that we can make to immediately expense an asset's cost or part of its cost instead of depreciating it over several years. This is, of course, subject to limits. Section 179 is only available on tangible personal property, not real property. You will also note that it is an annual election that we make on the property placed in service in the current year and is only available in the year that we place the asset in service. So what is the maximum amount that is allowed to be expensed under Section 179? This amount, you will find, changes every year. For 2012 through 2014, the maximum amount that you could expense under Section 179 was $500,000. As of January 1st of 2015, the limit was reduced back down to $25,000. That is likely to be extended back up to $500,000 before the end of 2015, but at the time of this video, it had still not yet been extended. Please note that the limit for Section 179 is per taxpayer per year, not per asset, and it can be split over several assets as desired. So, further limits that we have for Section 179, the first of which is what we call the ceiling or threshold limitation. We have a ceiling or threshold that we cannot exceed. If we place more than the ceiling limitation in service of tangible personal property during the year, then the excess over that threshold will reduce the maximum Section 179 dollar for dollar. For example, in 2012 through 2014, when the maximum Section 179 deduction allowed was $500,000, the threshold or ceiling limitation was $2 million. That meant that if you placed more than $2 million worth of tangible personal property in service during the year, the amount that you exceed that $2 million would reduce the $500,000 deduction ability dollar for dollar. Note that right now in 2015, when the maximum Section 179 is $25,000, the threshold or ceiling limitation is $200,000. In addition, the second limitation is what we call the taxable income limitation. You must have enough taxable income before deducting the Section 179 to cover that. In other words, Section 179 cannot be used to create a loss for the year. You can decide to expense more under Section 179 on a particular asset than can be deducted in the current year, and that can be carried forward to the next year when you can deduct it. In addition, we have an additional limitation for SUVs, sport utility vehicles, between 6,000 and 14,000 pounds. The maximum Section 179 for the year on an SUV is $25,000. Right now, when the maximum limit for Section 179 is $25,000, that does not become an additional limitation. However, even if the maximum Section 179 is increased back up to $500,000, the maximum Section 179 deduction for the year on an SUV will remain at $25,000. So what effect does taking a Section 179 deduction have on the depreciable basis of an asset? The depreciable basis is going to be reduced by any amount that you expense under Section 179. That way, the balance of the depreciable basis is what we'll use to calculate the regular MACRS depreciation. Once you've expensed it, it's already done. Let's do an example on for using Section 179. If a taxpayer acquires two pieces of equipment, both 5-year property, during the year, one on 2/15/14 for $400,000 and the other on 3/20/14 for $300,000, and wants to deduct as much via Section 179 as possible, and their taxable income before Section 179 deduction is $750,000. Here's what happened for the year 1 depreciation. Asset 1, which cost $400,000, can all be expensed under Section 179. That gives us $400,000, Section 179. Since we have not exceeded the ceiling or threshold limitation of $2 million, the total that we placed in service of tangible personal property is the total of the two assets and a total of $700,000. We still have another $100,000 that we can take in Section 179 deduction. So on asset 2, which costs $300,000, we can take another $100,000 worth of Section 179 off of that asset, now bringing us to the maximum $500,000 worth of Section 179 that we can take. That will still leave us a depreciable basis of $200,000 on asset 2. We will then use that $200,000 depreciable basis to calculate the regular MACRS as we did in video 2. If you look in the table under 5-year property for tangible personal property using the half-year convention for year 1 recovery, you will see that the rate is 20%. 20% of $200,000 would give us another $40,000 regular MACRS depreciation. Therefore, we would have a total depreciation for the year of $540,000. In addition to Section 179, the government has also, in recent years, put in an additional first-year depreciation that we are able to take called bonus depreciation. This came about as part of the 2008 economic stimulus package. What it does is it allows us to take an additional 50% of the basis as bonus depreciation during the first year placed in service. Please note, however, that additional first-year bonus depreciation is only available on new tangible personal property that is placed in service during the year. If you choose to buy used tangible personal property, that is not available for bonus depreciation. Section 179 you can take on new or used property. This was extended through December of 2014. However, it is currently not available on 2015 assets. If the limits are changed during 2015 for Section 179 and they go back up to $500,000, I feel very confident the bonus depreciation would also be extended into 2015. At the time of this video, there was a bill already through the House to extend the bonus depreciation into 2015 and to raise the limit on Section 179 to $500,000. So what is the effect on the basis if you take additional first-year bonus depreciation? Like Section 179, any amount that you expense immediately via bonus depreciation will reduce the basis for regular MACRS depreciation. This should make perfect sense as you've already expensed this amount. So what is the proper ordering of all these cost recovery deductions? If you should decide to take Section 179 and take bonus depreciation and want to take regular MACRS, in what order should you do this? The proper order is, if you're going to take Section 179, then you must take that first. You are then going to reduce the depreciable basis by any deduction you take under Section 179. If you choose to take additional first-year bonus depreciation, then that would be done after you take Section 179 if you choose to take Section 179. And again, you would reduce the depreciable basis by any deduction that you take on bonus depreciation. This would leave you a depreciable basis after deducting Section 179 and bonus depreciation, and then you would calculate your regular MACRS calculated on that balance of depreciable basis. Let's look at an example using bonus depreciation. Continuing our early example, after the Section 179 is taken, again, on Asset 1, we took all $400,000 as Section 179 immediate expense, so that's already expensed. On Asset 2, which cost us $300,000, remember we took an additional $100,000 Section 179 to make up our total $500,000 worth of Section 179 that we were allowed to take. When we reduce the basis, we still have a $200,000 balance. If we decide to take bonus depreciation, then we would take 50% of that balance as bonus depreciation, thereby giving us another $100,000 worth of depreciation under bonus depreciation. When we reduce the basis by that $100,000, that would leave us a final depreciable basis of $100,000 to calculate regular MACRS depreciation. Again, since it's 5-year property, year 1 recovery, the recovery rate is 20%. So we would calculate 20% of the $100,000 and take another $20,000 regular MACRS depreciation. This would give us a total depreciation amount for the year for this taxpayer of $620,000. When we did our depreciation going forward in the next year, we would continue to use the $100,000 depreciable basis and multiply it times the applicable rate for the recovery year for regular MACRS. And this concludes our discussion on Section 179 and bonus depreciation.